Hello and welcome to Learn Fast with HK. Today we are going to understand yield to maturity with real life examples. And the examples that I'm going to take will belong to a company called General Electric. So we are going to use the General Electric bond, which is trading in the market at around 102 Mexican peso. And we are going to calculate the yield to maturity for that bond. And I'm going to take you through the different attributes of that bond and how that bond looks when it trades in the market. So let's go ahead. I'm going to open my browser. I'm going to search the bond. So we are looking for General Electric bond, and General Electric is one company that I know issues a lot of bonds. And I was pretty sure that they would be having some bond which is trading in the market. Now, this is how the bond looks like. These are the details of the bond. It's a General Electric company bond. 0722. So the bond was issued in July. Oh, sorry, the bond was issued in 2007, and the bond is going to be redeemed in 2022. So it's a 15-year bond, and this is how the medium-term notes are structured. So they consist of around 15 years approximately. That's the current price of the bond. It's trading at 102.61 Mexican peso. That's the currency of the bond. And this is the change in the bond price for today. Let me just scroll down for some more details. And this is the price of the bond. This is the way it has fluctuated in the last 1 year or so from 2019. And let me just scroll down further to show you some more details about this bond. Okay, this coupon, okay, yes, the coupon is given in percentage, so that's 8.35%. Or you can say if it's 100 Mexican peso bond, then you will get 8.35 Mexican peso as a coupon on this bond. Coupon is just like the interest that you earn on the bond every year. Sometimes it is paid on semi-annual basis. Sometimes it's also paid on quarterly basis. So it really depends on how the bond is structured. In this case, it's an annual pay bond. And as you can see, the currency is Mexican peso. Let's look at some more details. It's a General Electric medium-term note. Country is USA because General Electric is a US company. That's the volumes. These are the number of bonds that were issued, and again the currency. This is the face value of the bond. So you can say that after at maturity, this is what you're going to go. This is what you're going to get back. So if you had purchased one bond, you will get 100 Mexican pesos back from the company. That's the par value of the bond, you can say. That's the issue date. That's the coupon, and that's the denomination. So this is how the bond is structured, and I think we have just so it's not a floater. It's a fixed rate bond. It's not a floating rate bond. And I think we have gone through all the details. Now our main focus is going to be on the coupon that the bond is paying and the price at which the bond is trading, because these two things matter a lot when you are calculating the yield to maturity or YTM. And the third thing that will matter is the face value of the bond, which is 100 Mexican pesos. So we are going to take it as 100, which means that after a couple of years, you will get 100 Mexican peso back from General Electric. And I think the fourth thing that will matter is the tenure of the bond. So from now on, I think around 2 years are left for the bond to mature. So we are going to take the tenure as 2 years. And this is when we are going to get back the money. And now let's move on to the calculation of YTM of the bond. So I'm just going to write down the equation that is used to calculate the YTM of the bond. It's a discounted cash flow equation. So this is how the bond is structured. We have the present value of the bond, which is $102 in this case. And then this present value basically consists of all the future cash flows that are supposed to come in the next few years. So cash flow that's received at the end of year one, then it's counted as some rate. That rate that we are talking about is nothing but the YTM. And then we keep on adding all the cash flows that we are supposed to receive in the next few years. And let's suppose it's a 15-year bond, as in our case. And then we discount this by 15 years. Now, at the end of the tenure of the bond, we are not only going to get the coupon, but we are also going to receive the principal of the bond, which is 100 Mexican pesos in our case. And this is how the equation of the bond looks like. Now, manually, it will be very difficult to calculate R or YTM. So for that purpose, we use the BA2 plus calculator, and that's what I'm going to use today. And that's the calculator that's recommended for CFA students. And let me just get to the calculator now. So this is how it looks. So I already have some calculation up on this calculator. I'm just going to clear this. I'm pressing second and then clear TVM, or maybe you can say second and clear work. It will just wash out everything that you did on the calculator, and now your calculator is absolutely fresh to make any calculations. Okay, now let's go ahead and feed in some figures. So let me just write down what all we have. So we have the PV, and the PV of the bond is 102.61. So this is what you need to pay in order to purchase the bond right now. You will have to hold the bond for 2 years. I by Y. So this is nothing but R, and we do not know this. So we need to find this, or this will be our yield to maturity. And we already know the future value or the face value of the bond is 100 or 100 Mexican peso. And I think that's about it. That's all we need in order to calculate the present value, the yield of the bond, or the yield to maturity of the bond. And let's get on to it. So I'm just going to get back to my calculator. And since it's clear now, let me just enter the figures one by one. So PV is 102.61. Now, since this is the price that we have to pay, it will go out of our pocket. And I'm taking it as a negative thing because we have to pay this. It's an outflow. And I'm going to store it under PV. Then we have tenure, which is 2, because we are going to hold the bond for 2 years, after which the money will be paid to us by the company. And I'm going to store it under N. N is nothing but the tenure. I by Y we don't know, so we cannot write anything here under I by Y. 100 is something that we will receive after 2 years, so that becomes our future value. One thing we missed was the coupon payment. So I'm just going to write down payment. That's 8.35%, or you can say 8.35 Mexican peso. So 8.35 of 100. So coupon is always based on the par value. So par value in our case is 100, and the coupon will be 8.35 Mexican peso. Coupon is also an inflow, so I'm going to take it as a positive figure. I'm sorry. Let me just add a decimal to it. Right, and now store it in PMT. And I think we're done with all the values, and now we just need to compute I by Y, which comes out to be 6.90. So I'm just going to write it somewhere. So 6.90 is our YTM. Now, 6.90 is basically in percentage terms. And you can say that this is the return that you will earn if you hold the bond until maturity. And I should rather say that this is the approximate return that you would earn if you hold the bond until maturity, because it depends on a couple of more conditions, which I will come to. And so all in all, if I want to say what it is, basically, if you purchase the bond right now at 102.61 and receive 8.35 Mexican peso of coupon for the next 2 years, and then get 100 Mexican peso back at maturity, then the total return that you should earn in these 2 years should be 6.90% per annum. And that's what the YTM means. Now, 6.90 is, I would say, an approximate number because it depends on a couple of conditions, which I will focus on. Before I go to that, I just want to show you a very interesting thing. So you must be thinking that 8.35 is the coupon payment of the bond. So this is something that we are receiving as an interest from the company. And this is what our return should be. Well, exactly. That is right. So 8.35 is the interest payment that you are receiving from General Electric. And this is what your return should be technically. But you also need to discount the fact that you purchased this bond at a premium. Had you purchased this bond at 100 Mexican peso and redeemed it at 100 Mexican peso, and in between you would have earned like 8.35, your total return at the end would have remained at 8.35 only. But you bought this bond at an expensive price, which is 102.61 rather than 100. And that's the reason your total return decreased from 8.35 to 6.90. It's a two-way thing. Had you bought this bond at a discount, let's say 98 Mexican peso, in that case, your YTM would have been more than 8.35. So this is how it works. And that's how the yield to maturity works. And now let me just go back to some conditions. So these are the conditions if you want to earn that 6.90% of YTM by purchasing this bond. So the first condition is that all the payments of coupon and principal must be made in full, which means that General Electric should not default on any payment and should not make any late payments. Otherwise, your return will fluctuate. The bond should be held until maturity. So you should not sell the bond before maturity, because if you sell the bond before maturity, you would sell it at its market price, and then the entire return calculation of 6.90 will be disturbed, and you will earn altogether a different return whatsoever. So that's the second condition. The third condition is that the bond should not have any embedded option like call or put, which means that the company should not call the bond back before 2 years, or you should not put the bond back to the company before 2 years. These are the embedded options. So call option is the option with the company to call the bond back before maturity. So if the company does that, then again, the entire calculation gets disturbed and you do not earn that yield to maturity that we calculated. The same thing happens if you give the bond back to the company before maturity. So again, you do not earn that return that we calculated. And the fourth condition I have highlighted in red because it is the most difficult condition to meet. And it says that all the coupons of the bond must be reinvested at YTM only. I'll just show you what it means. It means that 8.35 Mexican pesos that you're receiving here should be reinvested at 6.90% for the next 1 year, which means until the maturity of the bond. Now, that is very difficult to happen because we never know that after 1 year, when we get the coupon from General Electric, what will be the interest rates? The interest rates could be higher than 6.90 or lower than 6.90, or maybe exactly 6.90, but then the probability of interest rates being exactly 6.90 is very less. And since this condition is very difficult to meet, at the end you will earn something else, and that return will be a little different from 6.90%. So instead of 6.90, let's imagine if you invest this coupon that you receive after 1 year at 10%. So in that case, your YTM, in total YTM, will increase because you have reinvested your coupons at a very high interest rate, which is a great thing. On the other hand, if you reinvest your coupon at a lower interest rate, then your YTM, the ultimate return that you will earn from the bond will decrease because you have invested your coupons at a very low rate, and this is how it will work. So the last condition, all in all, I would say is very difficult to meet, and this is the reason I was saying that this is an approximate return that you should expect from the bond. It is very difficult to get exactly the same return that is calculated as a part of YTM. And if you do, that's a great thing. But in most of the cases, that's not the return that the bondholder earns. I think that's about it. That was yield to maturity for you. And if you have any further questions, please mention it in the comments, and please like my page and press the bell icon. And for any support or any online classes or any queries, if you need, please contact me at the given contact details. Thank you for watching the video. Bye-bye.